Over the past 10 years, there's been over $165 billion worth of venture capital invested in the software space, and the results of that have been pretty amazing. Gartner's now tracking over 700 different categories of software. There's software to calculate sales commissions, there's software to calculate your carbon footprint, there's software to analyze your legal bills, there's software to track your customer references. But one big area that's been missed is this area of leasing. There's over $5 trillion worth of assets that are leased around the world. One simple example of that is just office space. Most companies don't own the buildings that their employees go to work in every day, whether that's a factory or warehouse, an office building, or a call center. And the same thing is true of a lot of the other assets they have. Company cars, international benefit plans, laptops that the sales team has, the trucks and the rail cars that are moving goods through the supply chain, in many cases are leased rather than owned. And the challenge is that traditional enterprise resource planning, ERP systems, were designed to manage assets that you own, not assets that you lease. Now, a lot of people would say, well, is leasing really a business process? It sounds more like a financing mechanism to me. Well, regardless of what you want to call it, it's a financing mechanism that drives a unique set of workflows and use cases that traditional ERP systems don't support. So let's take an easy example of that is really the way you manage your financial processes around leasing. So there's a special set of accounting rules that need to be used for leases that are different than plant, property, and equipment that you own. Special balance sheet treatment, special income statement treatment, special disclosures that you've got to issue to the SEC and different regulators around the world. But the differences are much deeper than just accounting. There's special tax rules for leasing. So you pay property taxes, you pay sales taxes, you pay income taxes on things that you lease. There's differences at a federal, at a state, at a local level. The invoicing processes for leases are different. Landlord bills with real estate invoices are notoriously complex. The rent that you pay for a particular property can vary on a monthly basis based on the prevailing labor union wage in the city that you're in, based on the rate of inflation. And landlords are notorious for overbilling their tenants. You can't just have the accounts payable group rubber stamping invoices and paying them. You've got to feed the invoices into sophisticated spend analysis algorithms to identify areas of waste and inefficiency where you might be being overbilled. Another good example of where leasing is different is around tracking assets. Now, we like to call these things fixed assets, but they're really not fixed in a lot of cases. Trucks, laptops, forklifts, these things move around from location to location. When they move, sometimes you lose track of them. Sometimes they're stolen, sometimes they're damaged. Now, you're not going to lose a building, but you might lose some of the 2,000 laptops that you've leased for your sales team. You might lose some of the 800 rail cars that are moving around the US, Canada, Mexico, moving your goods through your supply chain. Or you might just forget about something and forget to return it at the end of the lease. So that forklift that you had planned to lease for 5 years ends up hanging around for 10, 12, 15 years. It ends up costing you 2 or 3x what it would have cost you to just buy it up front. Another big challenge with leasing is just there's a tremendous amount of logistics and planning that need to happen because you're leasing things for a finite period of time. At some point, the lease comes to an end. Well, what do you do then? You've got to decide 6 months, sometimes 9 months in advance. Am I going to renew the lease? Am I going to terminate it? If I'm going to end it, am I going to replace it with something else? And that whole replacement process is complex as well. So that server running your data center that you're leasing, you want to get a newer one that's faster with a better processor and more memory? Great, but where's that business application that you're running that server on going to move to at the end of the lease? You've got to have another server lined up. Well, what happens if in the last few weeks before your switchover, you find out there's a supply chain problem, you can't get a new one? So there's a lot of complexity in leasing, a lot of unique business processes that ERP systems were not designed to handle. ERP systems don't have workflows for renewing leases. They don't have the complex accounting engines that you need to do your SEC disclosures. They don't have reports and dashboards that allow you to track the economic performance of leasing. But the good news is that CFOs are really waking up to this challenge. There's trillions of dollars of leases moving onto corporate balance sheets in the next couple of years as the US GAAP and international financial reporting standards are changing around the world. And CFOs are realizing they really don't have a handle on what they lease, and they need to put a lot more automation and policies and processes and controls in place. And that's really why we're seeing such a massive uptake in enterprise lease accounting software.